There are 7 sins of investing that we're going to be going over in this video right here. Now, there are 3 things I want you guys to do while you're watching this video. Number 1, have a calendar ready so we can start time blocking to take care of some of these items. Number 2, have a pen and a piece of paper to make some great notes. And number 3, hit the like button because that always helps with investing. Actually, it really just helps with the YouTube algorithm, but I do greatly appreciate it if you'd hit like, hit subscribe, and away we go. As a disclaimer, I am not a financial advisor. However, I am a real estate broker here in Southeast Michigan and Ann Arbor, and would love the opportunity to earn your business for you and your family's next move, whether you're purchasing or selling a home. Sin number 1. Holding cash in their retirement accounts. Now, this is a big one. Studies are showing that the average American has $9,700 in cash, not invested in stocks, mutuals, bonds, ETFs. This is a problem because what you're making on your investment at that point in time is relative to, very similar to, pretty much on point to, a money market account. And what do money markets pay? Pretty close to zero. In fact, looking at both NerdWallet and Bankrate, we looked at the top performing money market account and we found that the average was paying 0.45%. 0.45%. The top accounts are paying 0.6%. Now, that said, the Dow, the S&P, the NASDAQ, those are all up 25 to 30% year over year. So you left a ton of money on the table. Here's what's worse. The money also devalues over time. With the inflation rate at and above 7% currently, even if you're making 0.5% in your money market account, that money is actually worth 6.5% less at the end of the year. We're not talking about mattress money. I'm not talking about your emergency fund where you do need cash at hand and readily available. I'm talking about your retirement fund. This must be allocated towards ETFs, stocks, bonds, mutuals immediately. So step 1 is log into that account, see how much cash is there, and create a plan to get that moved out of the cash account into a wealth building vehicle immediately. Sin number 2, investing in individual stocks. Over a long enough period of time, 90% of all companies will in fact go out of business. They will go defunct, they will declare bankruptcy, that's it, kaput, your stock is worth zero. And here's the problem with this. Even in bankruptcy, when the court orders all the assets to be sold and all the payouts to be done, the shareholders, the stockholders are the very last people to get paid. So no matter what the stock value is, your payout on a bankruptcy is probably close to zero, especially if you're buying Class B shares. And these were once thought as stable and safe investments. For every Amazon, Apple, Google, Facebook company there is, yes, I just named all the FAANG companies, there are just as many Kodak, Sears, Polaroid, Blockbusters out there that go defunct and go out of business due to poor management at the top. Now, a lot of these companies like Kodak and Blockbuster, for example, they had great opportunities to adopt new technology and to pivot and change. Hey, let's rake in some short-term cash instead of pivoting our technology. Blockbuster clearly lost to Netflix because they wanted to keep raking in those late fees. Kodak lost to the digital camera because they made their money on film and film development. So what do we do now? Instead of investing in individual stocks, which we gotta watch and we gotta manage, which causes more stress and more anxiety, put the money into a great index fund like an S&P 500, a Russell 5000, an ETF, or a mutual fund where you can literally set it and forget it over a basket of stocks that is actively managed on your behalf by a fund advisor. Now, this is so much better because over time, they will reweight and redistribute themselves. So all you need to know is, hey, every time I'm inputting money, I just buy some more shares of this and it will take care of itself. Sin number 3, not buying a home as early as possible in your life. Now, I will concede that there are a few specific circumstances that can arise where it's much better to rent than to own. The one that always comes to mind is somebody who's going to be moving in the next 24 months or less. If you already know you're going to be moving, or if you're on contract somewhere for a short period of time, you need to be in a home a minimum of 24 months to break even on any fees associated with selling that home. For everyone else, go buy a house. In fact, there is no point in U.S. history where renting has ever made sense over buying long term. And I'm going to talk about that. Currently here in Metro Detroit, we'll use my hometown as the example, the average rents are now exceeding $1,600 per month. Now, if you were to take that $1,600 and put it towards a mortgage at the current interest rates, plus taxes, plus insurance, you could buy a home for $300,000 for the same as you're paying rent. I will also say this, when you're going into a home, there are a couple other things you need to be aware of. There's going to be some maintenance costs, some upkeep costs, some replacement costs, and generally that's about 0.5 to 0.75% per year. So about $1,500 to $2,000 on that $300,000 house per year. That's going to happen. But on the flip side, you're also going to start receiving a tax benefit. So the government loves home ownership, right? They're going to reward it. And how they do that is the mortgage interest deduction, the MID. What they're saying is when you're paying interest on a home loan, you can deduct that off your income. And at the end of the year, you're going to get a check back if you're a W-2 or pay less as a 1099 like myself to the government and your income tax. Generally speaking, in Metro Detroit, that average is $2,200, which exceeds whatever the maintenance cost of the home is going to be. And that's just one perk of home ownership. In addition to that, you're going to be paying off a loan every single month, increasing your equity in that property. Right now, the average American is living living in their home for 11 years. So what that means over that 11 years, two things are going to happen. One, you're going to pay that mortgage down $79,000. Two, you're going to get tax reimbursements from the government or tax write-offs in the amount of $2,000 per year or $24,000. So that's a $103,000 push, even if property values just flatlined and never went up. $103,000 in your favor. But people have asked, Mike, what about this real estate bubble we seem to be finding ourselves in? And I say, hey, look at the $103,000. At the end of that 11-year period, your home value will have had to have fallen 27.5% to eat up the $103,000 and still break even on closing cost of selling the property. 27.5%. Does anybody think that's really going to happen? Now, that's not even the crazy part. On top of the tax write-off and on top of the equity you're building by paying down the loan, rents have been going up over the last 50 years, 3 to 5% on average every single year. In 2022 alone, rents went up nationwide roughly 14%. Here in Metro Detroit and Ann Arbor, we saw a 1-year increase of 16.5% for the average rent for an apartment or a home. So this is crazy, right? When you get your loan and the loan payment is $1,600 per month in this example, every single payment after that remains at $1,600 a month until you either refi, you want to pull out some money, you sell, you go to a different property, any of those things occur. But if you don't touch it, it will remain at $1,600, unlike rent. Eventually that rent's going to go up. In fact, over 5 years, using the conservative estimate of 3%, which is super conservative, your new rent on that $1,600 home per month or apartment per month will be $1,854. Over a 10-year period, that $1,600 property will then be renting for $2,200. So it's more than just a home payment. It's more than just a couple of bucks back on your taxes. It's protecting against the rent increases that are eventual, and they always happen. Sin number 4, timing the market. This is one of the greatest fallacies ever told. Buy low, sell high, time the market, watch the market. Forget all of that. Let's go to the prime example of Warren Buffett. I think we can all agree that he is one of the, if not the best investor of all time. However, his name will never show up on any sort of a top 50 list. In fact, his any year returns never make a top 50 list, never even make a top 100 list as far as investors go. What Warren Buffett, the Oracle from Omaha, has is time. So he has been a consistent investor for literally 70 years. So time over task. And one of the reasons he's one of the best investors is because he will ride out a low price to get back to a high price. He doesn't get spooked. He's not going to pinch pennies to lose dollars. That's not him. So there's an old Japanese proverb. When is the best time to plant a tree? 20 years ago. When is the second best time to plant a tree? Today. The point of the proverb is, yes, we could have done a lot of things 20 years ago. We could have made a lot of different decisions or choices. We could have bought Apple stock when it was $5 a share 15 years ago. Could have done all those things. But when to do it next is now. Take action today. So start investing and start your investing immediately. And if you need any more proof, Bank of America, Merrill Lynch, and Charles Schwab have all conducted multi-decade studies showing that had you invested on the best days and withheld the money out of the market until that time, you still would have lost money and you would not have gained as much money as if you had just continually invested steadily. Sin number 5, paying high fees. That is a thing of the past, guys. In fact, it was a thing of the past before there even was a past. There is 0 point in paying high fees to heavily managed mutual funds and ETFs. In fact, it will hinder your investing. Let me show you how. If you put $500 a month away into any sort of a mutual fund or an ETF at a high fee, let's call that 2% because that's where the high fee mutual funds and ETFs sit, versus a moderate or a low fee, which is what I invest in, about a 0.5% or less mutual fund or ETF, you came out almost double the profit over the same time period investing in mutuals and ETFs that both invested in the same companies. Let me break that down a little further. Let's pretend that you invested in a mutual fund that went up 10% in value this year, but you paid 2% in fees. That's actually 20% of your gains, right? So that 10%, 2 of the 10 points will be going towards the management versus 0.5%, which is 0.5. So let me break that down a little bit further. A 2% managed fund, if you put $100 into it and it goes up 10%, you have $110. But in a heavily managed fund, you don't, because 2 of those $10 you're going to be paying to them, leaving you a profit of $8 that will be reinvested for yet more profit each and every year. On a lower feed fund, like a 0.5 or a 0.4, if you're paying 50 cents per $100, right? You still go up that $110 of value, but you're only paying 50 cents, which means you have $9.50 you can reinvest worth of profit for more wealth accumulation. So I'm going to bottom line everybody on this. Let's say you put $500 a month away from the age of 20 to the age of 60. That's 40 years. On a heavily feed fund at 2%, you will have at the end of that time $1,386,000, which sounds like a lot of money. But on a similar fund with a similar investment with a 0.5%, you will actually have gained $3,180,000. That's almost double a heavily feed versus a lightly feed fund. Sin number 6, thinking short term. How do I double my money this month? How do I double it this week? How do I double it over the weekend? How do I double it today? What's the secret? Nothing, guys. There's absolutely no secret. Time equals money. Time is a function of money. There are reasons why these sayings keep on getting said over and over and continue to ring true. But also time is a function of success. I'm going to use a different example to illustrate this point. Michael Phelps started swimming when he was 7 years old, but it took him 12 years of dedication, of pain, of pushing, of all of that to get to his first gold medal. He didn't wake up one day, jump in the pool, fool around for 6 months, and then go get a gold medal at the Olympics. No. In fact, the first time he was at the Olympics, he didn't even place. Moral of the story is every overnight success is really decades long in the making, and investing success is no different. Now I'm going to go ahead and line extend out what that 12 years of Michael Phelps would be on an investment portfolio. If you invested at $10,000 in an S&P 500 12 years ago from the taping of this film to today, it would have tripled in value. Would have gone from $10,000 to $30,000. And all you need to do is buy that one mutual fund and nothing else. So the last Achilles heel of looking for that overnight success is FOMO, right? The fear of missing out. We are getting blasted with these news articles about crypto, about meme stocks, about all of these things. And so what we do is we rush into the market, we pull out of the market, we see things start going up and we feel like we missed out, we see things going down and we're like, oh no, our investments are sinking. Forget all of that. Guys, an easy, simple S&P 500 fund, a NASDAQ fund, a Russell fund, just set it and forget it. Get out there and enjoy your lives. Stop checking the stock ticker every 20 minutes. Sin number 7, the mistake I see people make the most is not investing early enough and not investing with enough frequency. The sooner you can begin investing, the sooner that money will compound against itself. In fact, check this out. Here's a tale of two investors. Here's one investor that invested $500 a month, so $6,000 a year, for 40 years. And they just let the money sit there. They put it into a mutual fund or an ETF and just let it grow on its own, but they consistently invested the $500 per month or $6,000 per year. The other investor in this example put in $500 per year for 10 years. Now, at the end of that time period, the 10-year person only had $6,900, right? They only gained $900 on the $6,000 that they had invested over 10 years. Conversely, the original person that did $5,000 a month or $6,000 a year for 40 years, that person ended with $1,136,000. That's a big difference. $900 versus $700,000. I'm not even kidding. Not even kidding. $1,190,000 more than example B. That person invested early and invested often. And those are the 7 deadly sins of investing. I've seen a lot of people in the past violate one or more of these 7 principles of investing. I have been guilty of all 7 of them at one point or another myself, but I do know this. If we can work hard at fixing each one of these, get it on the calendar, research it, make those changes, they will compound against each other for much higher gains and much higher wealth building. And you owe it to yourself, you owe it to your family. Arm yourself with the information. Thank you again, everybody. Give me a call with some of your success stories as well. I'd love to hear what people are doing with this information, how it's changing their life and changing their investing. And in addition, we'd be honored to receive a call if you're considering purchasing or selling a home here in Metro Detroit. If you haven't already, like and subscribe, and I will catch you on the next video.